Good afternoon and welcome everyone to the Manulife Investment Management Asset Class Outlook webinar series. Just a quick couple of housekeeping points before we kick off today. For those of you who dial in, we appreciate you stay on mute throughout the session. And for those of you who join via the webinar, you can submit questions below the screen during the live webinar session. We'll endeavor to address as many questions as we can. Our speaker today, Paul Calogero, Client Portfolio Manager of Multi-Asset, will explore opportunities in both traditional and non-traditional global asset classes that could help to balance risk. Over to you, Paul.
Thank you very much, Daphne, and welcome everybody from what is today particularly dreary Hong Kong. I suspect we are all glad to see the back of a particularly challenging March month, and looking forward to some warmer months ahead and an improved investment climate for our investors. So it's fantastic today to have our key distributors and clients here on this webinar series. I hope the series is engaging and I hope the series is insightful. And given the brief 15 minutes we have, I'd like to get straight into our current insights into the global multi-asset diversified income asset classes. So first, I'd like to give a market overview and to set the scene and to also define where we are at. So over the last few weeks, we've experienced an event-driven risk-off environment where virtually all market participants appear indiscriminate in attempting to shed risk and increase liquidity. Overall, we see this less about systemic risk, although the system was under severe strain, and more about dealing with a crisis of uncertain depth and duration. So from a fundamental perspective, the best approach we can do at this point is test and retest our investment thesis with an eye towards stressing business models for an acute deterioration of cash flows. Yields and spreads will likely peak well before default rates peak, and that will take time for that to work through the system, whilst the duration of the virus and depth still remains unknown. But markets are eventually expected to re-risk. The key question here is what to do between now and then. And just to follow on from that, in terms of an asset class overview, what we are presenting today is an outcome-oriented asset class targeting a high distribution yield through a diversified source of income, which includes equity dividends, fixed income coupon payments, and also premiums from option writing. Therefore, the allocations within such a typical strategy will be a function of where we can derive that income and yield for investors. So let's move on to the first slide. Here we want to provide a brief introduction, and also I think the key overall message from this slide is the diversified elements of such an income approach. In fixed income alone, a typical diversified income strategy would have around 200 names, with the majority focused towards high yielding securities. So our view is that we can achieve a mid to high single digit distribution yield through these exposures, of which fixed income, both US high yield and emerging market debt hard currency, really is a key driver of that yield that we're looking to obtain. Other areas where we see a large amount of yield is in the REIT and preferred space. Now these segments have seen some liquidity challenges over the last month and have unfortunately exhibited equity-like drawdowns. However, we still see yield opportunities in some of the more defensive areas of preferreds in sectors such as utilities, electric and midstream energy. And we're still expecting a reasonable recovery in this space as the market returns back to a two-way price action rather than this one-way indiscriminate selling we saw in the first few weeks of March. Lastly, the bottom right-hand side of this chart within options, a parallel option component within a diversified income strategy has historically been somewhat of a buffer, but not as much as we would have hoped given the indiscriminate selling and rising correlations that we've seen across asset classes. Nevertheless, we have seen some adjustments here which I can detail later on in terms of harvesting that premium to ensure we retain the yield levels we are looking for. So the option component would allow a typical strategy to sell much of the future upside in exchange for current income and an improved drawdown outcome. If we move on to slide 3, here we look at fixed income. Now here we see the real driver of yields in a typical diversified income strategy, where we're getting around 6% in emerging market high yield and around 7 to 9% in US high yield and around 7% in preferreds. Now, in this slide, you can see some broad areas of exposure, and one theme I believe is worth focusing on, and an area I want to talk about, is on the communications, telecoms, and telecom infrastructure segment. This would include telecom operators globally, which pay good yields, but are also defensive business models with reasonable, transparent cash flows, and it's an area that we like in both emerging markets and US high yield. Typically, an area we do not like are certain segments of the energy sector. Now, these are undergoing market stress and are leveraged more towards oil prices. So exploration and production would be a subsector of that energy sector we are less constructive about, whilst we at least see better transparency in some of the midstream pipeline operators in terms of cash flows. Lastly, as previously mentioned, despite some liquidity challenges among some of the preferred, we still like many of these defensive business models and the yield opportunities within this area. And finally, just to touch upon some concerns on credit downgrades. As global growth slows, we do expect credits and government bonds to be downgraded. We've already seen quite a few, including Mexico and some of the larger automakers in the US. Now, given the multi-asset diversified income approach, this would mostly be a typically high yield rated portfolio as required to meet certain yield targets that a strategy may have. And these downgrades are less impactful, therefore, to a typical high yielding portfolio. So overall, we are expecting the downgrades and the spread widening to provide opportunities for fundamental credit investors to exploit over time. Longer-term investors should be looking at these valuations in fixed income, credits, high yield as opportunities that are unlikely to present themselves for a while. And now one key message here is that we don't expect to buy the bottom, but we do expect to buy value and opportunity, which is what we are seeing currently. If we move on to slide 4, here we want to highlight the US high yield market, which is pricing in default rates of around 9 to 10%. This level we see as too negative. We see defaults rising from the historical low 3% level, but we don't see 9%, and therefore we see segments of high yield as overly negative, and therefore it's a key area we are constructive about for a typical designated income portfolio. In terms of slide 5, if we can move on to slide 5, please. So looking at an equity component of a typical diversified income approach, here we would prefer higher quality global large cap champions. So what do we mean by quality? So quality here means a selection of equities that are cheaper in terms of multiples, with better profitability metrics and better balance sheets. And when we talk about balance sheets, we're sort of looking at those net debt equity ratios than say a global MSCI ACWI World benchmark. So this is an area we believe has sustainable franchises and market shares they can really protect. So areas we prefer here are consumer staples, particularly in Europe, given the valuations of Europe listed consumer staples, and their business models are more global, in some cases relatively defensive, within a steadily growing sector. Areas we don't like are in energy, and this area we would look to be underweight, as well as financials given lower rates for longer. Having said this, some of the US banks still look relatively better. We move on to slide 6. So here we would highlight the option strategy within a typical diversified income strategy. And the preference here would be on the right-hand side of this chart would be to write calls and write puts. So in this case, we would be harvesting a premium on these written options. The puts are likely to be fully cash collateralized, and the calls are written on the basket of equities at that sector and country level. In summary, we would achieve a premium or an income up front and sacrifice some of that future potential upside. Now, just to be a little bit more technical, the closer to the money we write these puts and calls, the higher the premium. However, this would open up a typical income strategy to greater risk in terms of drawdown, the more in the money the calls and the puts are written. So in terms of flexibility of this approach, there could be an occasion where we would shift the strikes of the calls and puts, or indeed remove part of the option strategy where we had higher conviction. We could, for example, look at a scenario of puts and calls at different moneyness and analyze the effect that would have on risk-adjusted returns and or drawdowns. The general approach, however, would be to write out of the money calls and at the money puts, and you could deviate around that depending on market conditions and volatilities. However, more recently, to enable a strategy to take advantage of an equity relief rally, we would remove that call writing element temporarily or tactically, for example, so as not to cap upside within the underlying basket of equities. Ultimately, an option strategy in general adds flexibility to such an approach. It provides an uncorrelated income source, given we only expect to receive one side of the premiums at any given time, although there could be occasions if markets were range bound, we would realize both premiums on both sides. If we look to move on to the outlook now, yields within fixed income are now looking very attractive, and that's versus global sovereign yields, particularly with US high yield and emerging markets high yield remaining a key source of yield for global investors. Now, as mentioned, within US high yield, we would look for high yielding securities with some defensive element to their business models, such as I highlighted before in telecoms, telco infrastructure, food and tech names. Within emerging markets, for example, we could look at high yielding securities that may have government support. Also in terms of sectors, we like our telco, cable and satellite providers, as well as select manufacturers. I think when we look at high yield and emerging market corporate bonds, they continue to have less liquidity than normal in this environment, but we do expect that price action to resume to normality in the near term. So we would be looking to add to already established positions in this environment where we see good yield, and also those corporates with government support at those attractive spreads and price. And just touching upon the quality of a typical approach in this environment. More broadly, typically we would look to improve the quality of the broad portfolio by adding some of the BBB names and also single A names. Also, in terms of the hybrid names, such as the preferreds, these have acted very much like equities in terms of drawdown. However, we still see a lot of yield in this area. However, we are mindful of some of the remaining stresses in some of these segments, such as we still see stress in mortgage and retail REITs, where we wouldn't typically be looking to add, given the continuing impact in this segment. In terms of equities, as mentioned, overall, we do not like financials, but have a preference for US banks. Similarly, we don't like energy, but we do prefer midstream within that energy sector, and also we prefer consumer staples, particularly in Europe. Then lastly, on options, as we have detailed, an option strategy gives such an income approach that's enhanced flexibility. In an environment like this, we may choose not to write covered calls on the equity basket. This is so a typical equity component of a typical portfolio can take full advantage of a rising market. If we then look at the put side, for example, if those puts, for example, were written last week and given the recent equity rally, those puts are now likely to be out of the money, which would benefit an income-oriented strategy also. So overall, despite having no covered call premiums, we can still see making around 1.3 times more premium, and that's due to the higher implied volatilities that we're experiencing in this broad market currently. What we could also do here is we could also stagger the options writing over the month instead of writing the options once per month. Now that reduces point-in-time risk, and it also allows a typical approach to capture different implied volatilities over time. Now, just to conclude, the concept of there is no other alternative is again gaining weight. Investors are being forced into corporate bonds, high yield, both US and emerging markets, and equities because government bond yields are so low or even negative. Now, in terms of inflation, now whether inflation will remain as invisible as it has been since 2009 will be another big question for markets. Ultimately, however, stronger inflation would again speak in favor of equities. Now, in terms of the virus, it's been extremely insidious and has been ultimately underestimated by the developed world for too long. I think what should not be underestimated is the adaptability and inventiveness of societies when so directly confronted with a crisis. So at this point, we believe it is not the time to capitulate, not even as investors, but markets are very likely to remain volatile for the time being. However, I think one should not completely close one's eyes to the opportunities. We believe the expected further negative headlines about the virus will be accompanied by more positive news over time. And as capital markets anticipate future developments, we can expect them to move on, even when the situation on the ground still seems to be worsening. So our overall core scenario would be that we have a reasonably good chance at this point of a recovery in equity prices and spreads to be more favorable by year end. In times like these, this almost seems like secondary consideration. So stay healthy, everybody, and take care of yourself and each other. This ends my formal presentation, and I'm happy to take a couple of questions if time permits.
Sure, Paul, thank you. We're going to open up for some questions now, and I see there's a number of questions coming up. One of the questions here is, following the recent market correction in the first quarter, do you have any idea on how to adjust an asset allocation of a typical income portfolio, like global multi-asset diversified income in the coming quarter?
Yeah, so I think we should first emphasize that today's presentation is in relation to a typical diversified income strategy. So whereby areas of yield would determine to a large extent allocations and exposures. Now, allocating towards equities, for example, away from fixed income would sacrifice some of that yield. So I think in terms of what has happened over the recent few weeks and looking forward into the next month or next quarter, the first area of adjustment here would be to improve the quality of such an income approach. But again, we have to be mindful that there is a trade-off here in terms of improving the quality and therefore less risk exposure, which in turn would give less yield. Ideally, we would look for an income-oriented approach where we would naturally look for where there is higher yields achievable, but without exposing our investors to outsized risk. So, for example, improving the quality, we may look into investment grade areas, just as an example, but also looking to add to maybe higher conviction areas, such as in preferreds or hybrids, where we see a lot of yield. And also on the equity side, we may add to the more defensive areas, such as consumer staples. We may also use some of the collateral, which was originally used for, say, a covered call strategy, and maybe add that more to fixed income names, particularly where markets have fallen and where we see maybe a rally. Now, without covered calls tactically, this would allow such a strategy to fully participate in the upside in an equity rally. But as I said before, also on the put side, depending on when the puts were written, they should also benefit here given the recent rally that we've had, as these are likely now to be out of the money.
Sure. Okay. Another question here is, traditionally, the use of option strategies aims to reduce downside risk. So how could investors achieve this goal given the volatile market conditions we're experiencing? Yeah,
so historically running option strategies, say in parallel or complementary to a vanilla equity portfolio, has achieved some cushion downside. Now, the latest event that we've experienced over the last few weeks, or we have seen, you could argue options haven't done as much as we thought they would have. Now, this is largely due to correlations rising across the board and across asset classes. Historically in down markets, we would offset some of that equity sell-off through keeping some of the call premiums, and we wouldn't look to capture as much downside as well in these periods as well. I think also in terms of using option strategies, You could also, what you could look to do is stagger those option writing periods, and you take advantage of the volatility over the month rather than any given point within the month. And that just adds a little bit more flexibility to an option strategy within an income, diversified income approach.
Okay, thank you. There is a question about the search for yield. So investors are searching for yield. How could investors find yields from this kind of global multi-asset diversified income approach?
Yes, so a diversified income approach has its advantages. And one key area is that the approach, as the name says, is diversified. And given the diversity involved in such an approach, this can tap liquidity, for example, from multiple asset classes and sources. So when we have liquidity challenges in one asset class, we can still access liquidity through other multi-asset sources within such an income strategy. So having those multiple income sources coming together allows for a sustainable, achievable yield outcome. Just as an example, in terms of yields and investors search for yield, we can achieve yields of 6 to 7% on aggregate on double BB names. Yields look a lot better than they did versus the end of 2019, and the search for that yield will become more prominent, even more so now, and this means higher yielding securities will remain well bid in this low interest rate environment for the next 3 to 5 years. So all of these income-oriented strategies are also likely to remain attractive to investors over this period.
Okay, thank you. There is a question about the recent slump in oil price. How would that affect related assets such as energy equities or high yield bonds? Yeah, so for an income portfolio, you'd therefore be looking, if you're talking about energy, you'd be looking on the fixed income component here. So if we then drill down within US high yield, and then we drill down into energy high yield, now these are trading at spreads around 1,800 basis points last time I looked. So quite distressed, and rightly so, given the glut or oversupply of oil, as well as a dearth of demand in this coronavirus world. So energy within high yield is approximately 9% of total US high yield. And of that 9%, approximately 70 to 80% are considered distressed. So energy is a big focus, and therefore the more leveraged here within energy would be that exploration and production names. Now these names are down around 45% if you count it from the peak of the market in mid-February to now. Also, oil field services names are now down over 40%. And these are areas within energy we would look to avoid. From a relative perspective, when we're looking at the whole of the energy sector, midstream energy would be an area we would prefer, although they too have been indiscriminately sold down. But when you look at these business models of these companies, they're generally involved with transporting gas or transporting commodities from point to point, or they have an element of they have pipeline assets where they receive cash flows on volumes of, for example, gas moved from point to point. So this would be seen as relatively more transparent in terms of cash flows, and would be an area within energy we do have preference for. I think the sector as a whole we wouldn't like in general, and we would look to either lighten up here on both the equity and the fixed income side. Having said that, there's a fair amount of developments occurring daily, particularly in terms of the dispute between Russia and Saudi Arabia. Now, how that develops over the next few days could cause a lot more volatility in the energy space going forward. So it's something to look out for tactically, and one that the portfolio managers are mindful of. Okay, we have time for 2 more questions here. So there is a question about your views on cross-asset correlations. How could investors benefit from diversification between asset classes in these markets, as we are experiencing very volatile markets these days? Yeah, so
at the peak of the market stress, we generally saw all correlations move towards 1. Now, obviously, the weakness we had in risk assets selling down and the weakness we had in equities, this bled also into options and also fixed income, where we saw betas, where we would like betas around 0.6, 0.7, but they probably moved to around 0.75, whilst the options component also moved to around 0.85. And we were continuing to move closer to market beta as that sell-off continued. So some of what we consider subordinate debt, such as prefers or hybrids or REIT equity space, these have acted a lot more like equities in this drawdown. So that selling of risk assets was indiscriminate, and therefore correlations broke down in this instant. So in short, diversification benefits, of course, exist in normal market conditions, but in this occasion, in the first few weeks of March, they were particularly lacking.
Last question here. So which asset classes are expected to have positive returns from your point of view?
So yeah, again, an income portfolio would be optimized to achieve maximum yield rather than optimized to be allocated to optimize for the maximum returns. And obviously, having option strategies running in parallel, they're there to bring forward future upside into current distributable income. Having said that, from a high income generating perspective, we would see more opportunities in US high yield rather than, say, emerging market debt, and that's largely a function of a relatively stronger US market, to the firepower of its central bank and the US government, and the quality of that growth within the US. However, large parts of, say, for example, emerging markets, we still see them as struggling to contain the coronavirus, areas such as India, Indonesia, Latin America, and therefore they will take a lot longer to recover. And also, when we look at areas where we see better quality of returns, relatively higher quality business models we see existing in the US, and therefore we would see better opportunities in US high yield, especially at these spread levels.
Thank you, Paul. Thank you very much, and we're going to end here. For those unanswered questions, our sales teams will follow up with you. We appreciate everybody's time, and thank you once again. Goodbye.